Hello, this is David. Welcome to the video review for Part 2, Topic 5, Tuckman's Chapter 8 from the book Fixed Income Securities, 3rd edition. And that chapter is called The Evolution of Short-Term Rates and the Shape of the Term Structure. As usual, there's an associated workbook. It's called T5.29.8. And the 29 indicates that this is reading 29 in the 2013 FRM syllabus. The 8 indicates Chapter 8 from Tuckman. It's called Shape, Follow, Risk, and it contains several worksheets. We're going to look at most of them in this video presentation, including pure expectations, volatility, Jensen's inequality, and the risk premium. Now, looking at these worksheets should certainly give you a detailed understanding as to what this chapter is about. However, if your goal is just to pass the FRM Part 2 exam, you'll notice I've tagged these worksheets as low relevance. So it's not that they're not interesting. I think they're very interesting. It's just a matter of priorities with respect to the goal of passing the exam. And so Chapter 8, this is a difficult reading, I think, on first pass. So just to give us an overview as to what it's trying to achieve, it's really, the reading is really in 3 large steps. And it's about the term structure, and it starts with the unrealistic model where the term structure is informed only by expectations. And then step 2 is going to add the uncertainty or volatility, and we'll show that convexity is the manifestation of this uncertainty volatility that acts as a force to pull the term structure down. I think that's the hardest concept in the reading from my perspective. Then the third step adds another factor to the model, if you will, to incorporate risk aversion, and that'll manifest as a risk premium that acts to push the term structure up. So you see how we have a baseline view that's unrealistic, where the term structure is only expectations. Then we're going to add uncertainty and watch the convexity pull that term structure down. And then we're going to add risk aversion and watch the risk premium push the term structure up. That's the overview. That's all the chapter is doing. And so it starts with, the aim is explain the role of interest rate expectations in determining the shape of the term structure. And so in the model, this is the page or worksheet, I should say, called Pure Expectations, because if you studied any fixed income in any of the financial certifications, really including the CFA, usually starts with pure expectations. And that's the idea that if we take the red line here, this is going to be a truncated term structure going out to the 3-year spot rate. And if the expectation, what we have are here some expectations about future 1-year rates, right? That's the expectation in square bracket. So let's just say the consensus expectation is that in 1 year, the 1-year rate's going to be 10%, like it is in all cases. We're starting with a 1-year spot rate of 10%. And we're just saying that the market has a consensus that next year it's going to be the same, unchanged at a 10%, again, a 1-year rate. And then further, the market also expects in 2 years, so that's 2 years forward, that the 1-year rate will also be 10%. So here we have expectations about future 1-year rates. And the idea with pure expectations is that we would end up here with a flat term structure with a 2-year spot rate at 10% and a 3-year spot rate at 10% as well. After all, nobody's expecting the 1-year rate to change. On the other hand, if there's an expectation that in 1 year, that 1-year rate is going to drop to 8%, and then maybe 2 years forward, the 1-year rate is going to drop to 6%, that would manifest under pure expectations a downward sloping term structure, as illustrated here in blue. If there's a consensus expectation that the 1-year rate will increase to 12%, and then in 2 years that 1-year rate up to 14%, we should see an upward sloping term structure. And now this is going to be true, really, basically through a no arbitrage argument. And we can, Tuckman prices under these expectations the 3-year spot rate as a function of the expected future rates. And here we end up with what's P, but it ends up being a discount factor. because after all, this is the discount factor that if we discounted that 3-year spot rate, that we can multiply by the future cash flow in order to convert to a present cash flow. And so here we have the numbers as well, the plot that we just looked at. If, for example, the expectation here under the increasing scenario is that the spot rate of 10% is today, that's observed, that 1-year spot rate is going to increase to 12 and then to 14, the implied 3-year rate here, under this formula right here, would be just under the 12%, right? So we've covered that. That's a topic that should be well covered in part 1, should be able to do that. So this pure expectations, first of all, note that expectations imply uncertainty, but this baseline is assuming away uncertainty. So that's why we said it's the unrealistic first stage. In this unrealistic base case, investors are agreeing on a single series of future spot rates. So you'll recall I kept saying that there's a market consensus. And if you think about that, that's very unrealistic, that everyone would believe that short-term rates, even if you think about in the actual marketplace, it's unrealistic to expect that everyone thinks the short-term rates are going to be the same in the future. Nevertheless, this pure expectation theory just assumes this unrealistic case under which the shape of the spot rate curve is determined solely by expected future spot rates. So that's sort of the summary of the pure expectations theory, and that allows us to reconcile the term structure with expected future spot rates. And those examples show that these expectations can serve to change the shape of the term structure, or put another way, we can look at the term structure under pure expectations and infer by the forward rates what the expected future spot rates are. But the key assumption there is that the forward rates embedded in the term structure are equal to the expected future spot rates. However, Tuckman says, a forecast can be very useful in describing the shape and level of the term structure over short-term horizons, but probably only the level of rates at very long horizons. So that was the first stage. Remember, we have 3 stages. The first one was the unrealistic base case where the market agrees, and we can infer expected future short rates based on the term structure, and it's really implied forwards. Now we add that second stage, and we're modeling volatility. So we're adding, let's note what we're adding here. It's an assumption of known volatility as manifest in the binomial interest rate tree. So there's an important idea here, and that is that investors do agree on the future nodes and up-down probabilities. So notice how volatility is being modeled here. In the binomial tree, we're not sure if the rate's going to evolve up or down, yet there is investor consensus or agreement on what those nodes are. So it's a very specific kind of uncertainty that's being modeled here. So in this first example from Tuckman, we start with a 10% rate, and these are all annual. So a little bit of a change here to make it a little more tractable to follow. Tuckman's shifted into an annual from a semi-annual mode, a little bit easier on us. But the 10-year short-term rate is going to either evolve up to 12% or down to 8%. So you notice we have what is a 200 basis point volatility, or 200 annual basis point volatility. So again, that the 12 goes up to 14 or down to 10 in a recombining tree. Now, under this model of uncertainty, or volatility, I should say, the 2-year spot rate ends up being 9.9818%. And so you can see here, the discount factor 0.826720 is computed. So we've done this before. It's by taking the 1 divided the 1.12 plus 1 over 1.08 and multiply that by that sum by 50%. So that's just really taking the weighted average of these nodes and then discounting here at the 10%. And so then we extract the 2-year spot rate and we observe that we get a spot rate that's less than the 10%. So while the expected spot rate in year 1 is really the average of 12 and 8, so you can visually see here that the expected spot rate in year 1, the expected 1-year spot rate is 10%. That does not mean that the 2-year spot rate is 10%. It's actually given by this slightly less 9.98%. Now, Tuckman then increases the volatility by going to 400, an annual basis point volatility of 400%. And the point is to illustrate that this 2-year spot rate is depressed even further from the 10%. So here we have a 2-year discount factor of 0.827541, implying a 2-year spot rate of 9.9272%. Right, we're computing a 2-year spot rate, so this discount factor here at year 1, this is simply taking 1 divided by the quantity 1 plus 14%. So in other words, this is 1 divided by 1.14. This node here is 1 divided by 1.06. It's only a 2-year spot rate. We can just do that simple division. Then this 0.827541 continues this backward induction, but is taking 50% of these two price nodes and discounting or dividing by 1.10. And so we end up with this initially what looks like a little bit of a paradox, that this 2-year spot rate is 9.9272% instead of 10%, even though this rate tree recombines, right? It goes up and then down to 10%, just like down to 6 and then up to 10%. So even the expected 1-year rate in 2 years remains 10%. The expected 1-year rate in 1 year is the average of these, which is 10%. The expected 1-year rate in year 2 is also 10%. However, owing to Jensen's inequality, the 2-year spot rate is less than the 10%. And furthermore, it's even more less than the 10% than it was in the previous slide where the basis point volatility was only 200%. See how we went from a very small gap to a slightly larger gap from the 10%. So the impact of volatility is to depress the term structure. And so now putting them side by side, and again, we're on that second stage here to show that volatility has a convexity effect, which is to pull down the term structure. Here on the left, we've got the 200 basis point volatility, and we see the difference between the expected 1-year rate of 10% and the 2-year spot rate is 1.82 basis points. See, that's just 10% minus this 2-year spot rate. And so Tuckman calls that the value of the convexity. But as we shift over to the right-hand column here, which is a 400 basis point or 4% volatility, still the same. Notice they still recombine to 10%, still have the same expected 1-year rate in 2 years of 10%. However, it's achieved with greater dispersion or volatility in the binomial tree. In that case, the value of convexity is more. 10% minus 9.9272% is 7.28 basis points. The value of convexity increases with the volatility. Okay, so we first say that the value of convexity increases with volatility, and then Tuckman's going to show that it also increases with maturity. We've seen this elsewhere just in calculating convexity for a bond. We've seen that it increases dramatically with maturity, and we see that as well here. Because now we take the same two assumptions on the left, 200 basis point, annual basis point volatility, on the right, 400. Now we're just computing a 3-year spot rate. So in other words, instead of just maturity here at year 2, we're computing discount factors from year 2, just one additional year. So we're adding that third node that you don't see here. And in this case, then, here's the 3-year spot rate and the 3-year spot rate. And then the value of convexity is 4.85 basis points under a 2% volatility, all the way up to 19.43 basis points under a 4% or 400 basis point volatility. And so now we can say that the value of convexity increases with volatility. And also, as we've seen here, in going from 2-year to 3-year spot rate, the value of convexity also increases with maturity. And so then the aim is calculate the convexity effect using Jensen's inequality. And so this is just the math around the phenomenon that we've just observed, namely that the convexity has the effect of lowering the yield and therefore increasing the price. And so here's the Jensen's inequality notation, and then which is to say the expectation of the quantity 1 over 1 plus the rate is greater than 1 over the expectation of 1 plus the rate. So difficult by itself, but here just with the same numerical examples that we've been looking at, that is to say a 10% spot rate that jumps up to 12% or down to 8%. So here we have the up and down at 12 and 8. 1 plus the rate is respectively 1 plus 1.12 or down to 1.08 with 50% probability of each. And so that means that if we look at the left-hand side here, the reciprocal 1 divided by 1 plus the rate, or 1 divided by 1.12 is 0.89. And here, the reciprocal 1 divided by 1.08 is 0.93. And then we're getting the expectation over here, the left side, by multiplying this by the 50%. So it's a weighted average here. The 0.89 times 50% is 0.45. The 0.93 times 50% is 0.46. Summing those, we get 0.90939. And then notice what we're doing right here is converting this into a price. We're discounting, right, at that 10%. That's the expected future rate is 10% weighted average, but discounted at the 10%. So here we have that 0.90939 divided by 1.10 gives us this price on this left-hand side, which is greater than the price if we just took 1 divided by 1.10 quantity squared, which would be 0.82645. See the difference there? Here we've just gone straight to this on the right, 1 divided by that discounted at 10% over 2 years. And so that ends up being, as we can see, a slightly lower price, just barely, 0.82672, just a little bit on the left, a little bit higher than the 0.82645 on the right. And so because this price is higher slightly, its yield is slightly lower. And so that's really the implementation of this Jensen's inequality that shows us here how that convexity effect has a slightly depressing effect on the yield. Okay, so that was the second stage. Remember, we started first with pure expectations, which is to say that the forward prices, the forward rates embedded in the term structure, are perfect predictors of the expected future spot rates. We know that's unrealistic. Then we added the volatility in the form of the binomial tree that investors agreed on. And then finally, that third is to assume that the investors are risk averse and they require some compensation for the volatility. And the way that Tuckman handles this, he suggested there are different ways to do this, is simply to add a risk premium to the rate. So investors can still expect this 10% to go up to 14 or down to 6, but they're going to attach a risk premium of 20 basis points. So for example, we can add 20 basis points per annum to the rate, such that the year one rate we use to discount instead of 14 is 14.2, and then adding another 20 here at year two, it's 18.4. The impact of these higher, so now in this approach, the risk premium is really informing, isn't it, a discount rate, and the effect of that higher discount rate is to lower the price. In this case, it's because this node here, 0.875657, it's a discount factor, is 1 divided by 1.142. So this node here is going to be slightly lower than it was before because it's discounting at a slightly it's using a discount rate that's 20 basis points higher. Similarly, this node as well. However, this price here is discounted here still at the 10%. Notice we didn't really change the 10%. That's an observed. That's where we started. We have that spot rate. We don't really have this. There's not really risk here, given the fact that we're starting on this node. We already know this node, so it does not have a risk premium attached to it. So these two nodes are still averaged and then discounted, which is to say divided by 1.1. However, owing to the fact that these two node prices are lower based on slightly higher discount rates, the implied 2-year spot rate, notice, has gone up to slightly above 10%. So we can see now that by adding the risk premium, this is a more intuitive outcome, I think. By adding the risk premium, we go the other direction than we went with convexity, which is, say, we're pushing the term structure up. And hopefully that makes sense. The more risk averse we are, the more we want compensation in the form of a lower price and a higher spot rate. So Tuckman sort of proves that this works. It's sort of self-fulfilling, of course, but by showing that the expected 1-year return for the buyer of this bond who has this risk aversion is in fact going to be not the 10%, but 10% plus that risk premium. So, which to say, this remains the binomial model that investors agree upon. But if you're the investor, you want the 20 basis point premium just owing to your risk aversion. That is to say, the fact that it could go down in addition to going up. And so the price you will pay for this bond reflects this 20 basis point premium illustrated right here. So you will pay this 826,035, so that's your investment, and with the expectation that it's going to, in year one, its expected price is going to be the average of these two values here. See how that's 0.5 times these two values, which in fact are using the 14 and the 6%. So the idea is just that the risk premium, by virtue of a slightly higher discount rates, has informed a slightly lower price that you will pay, but so that against that same future expected nodes, you're going to end up with a 10.20% return. So you get your risk premium back in a slightly higher expectation. And so this is really the compensation for 1 year of duration risk that's inherent in this 2-year zero coupon bond. And similarly, if you want to be compensated, if it's a 3-year bond, you're going to be compensated for 2 years of duration risk with an expected return of 10.40%, which is 20 basis points for each year that you want compensation for your risk aversion. Well, actually, I should say that it's compensation for 2 years of duration risk. So in this case, with a 3-year zero coupon bond, the 2 years of duration risks is reflecting the fact that these year 2 nodes are still using these discount rates, but the year 1 nodes, instead of the 14 and 6, are using the 14.2 and 6.2, the risk premium. So it's compensation for 2 years of duration risk in the 3-year zero coupon bond. Okay, so those are the 3 stages, and then Tuckman's got a plot in here, which is also in the worksheet. So it's based on real numbers that where I've replicated Tuckman's examples. And the chart in there really does summarize the entire reading, which is to say that we start with a 10% 1-year spot rate, and we've got different term structures with the idea that the shape of these term structures is informed by 2 forces, right? Volatility is, or let me look here. Let me look at the headline here. The risk premium is pushing the term structure up, which is to say that if you're a risk-averse investor, you're going to bring the price of that what you're going to pay is going to come down to reflect a higher discount rate and increase your expected return. That risk aversion is a risk premium that pushes the term structure up. So in green here, we have no risk premium. In blue, there's a 20 basis point risk premium. And in red, you can see there's a risk premium of 40 basis points, which really dominates, doesn't it? Because it's pushing the term structure up. That's offset by the other force, which is the convexity effect owing to volatility, which pulls the term structure down. So this green line here, which happens to model a risk aversion of 0, so I suppose that's risk neutrality, is completely dominated by the convexity effect of pulling the term structure down. The red line, on the other hand, is dominated by the risk premium pushing the term structure up. And the blue line in the middle is perhaps most interesting because it's showing that in the short run, the risk premium is dominating by pushing this up. However, in the long run, the convexity effect is dominating over the risk premium and bending this term structure back down. So that's one of the key findings here in Tuckman's, that in the short run, risk premium dominates. In the long run, in the long maturity, the convexity effect dominates, pulling the term structure down. And so that concludes, really, this Chapter 8 from Tuckman. Thanks very much.